we've got an hour where we're gonna dive deep into CDFIs, and I'm really excited to have convinced three awesome triangle people to talk about CDFIs at different scales. We have Shannon, Locke, and Elizabeth, and I would just let them take it away and do a little bit of self-introductions and then dive into the world of CDFIs.
My name is Shannon O'Shea, and I'm with a nonprofit called Carolina Community Impact. We are a certified community development financial institution, or CDFI. And we just
So I'm Locke Raper. I work with Self-Help, which got referenced in Mark's slide. We're a CDFI as well as two credit unions. So we're essentially three entities, Self-Help Ventures Fund, Self-Help Credit Union, and Self-Help Federal Credit Union. So we cover about 10 states or operate in about 10 states on the credit union side. Venture Fund isn't really limited geographically. And then I specifically work for something called Self-Help Climate Capital, which is sort of a sub-entity within Self-Help Venture Fund, which is part of another entity called Climate United, which was formed we're a partner with two other partners who received funding under the NCIF grant under the IRA or Inflation Reduction Act from the EPA. Basically, it was a very large grant to promote green lending throughout the country. So we received $7 billion. I have a few slides and you'll notice there's an asterisk on that part because at present, that money is sitting in a bank account with our name on it. We just can't access it because we're in a bit of a legal dispute with the EPA. But we think ultimately we will be able to get back. But in the interim, we have self-help resources to lend with.
Yeah, fantastic. Hey, y'all. Good afternoon. My name is Elizabeth Wilkes. I'm just down the road in Durham, North Carolina with Partner Community Capital, also referenced. I think it's mostly accurate. I do have updated flyers I can pass around with our latest and greatest information. But like Locke and Self-Help, we also would have been, and actually Shannon too would have been, able to deploy these green lending focused funds that are just currently caught up in the courts. But in the meantime, very briefly, Partner Community Capital actually used to be a subsidiary of the Conservation Fund, which does a lot of work with working lands, you may be familiar with. So a lot of our clients have been in adjacent sectors to y'all, and we work all over North Carolina. We have lenders in East North Carolina, West North Carolina. We have an office in Asheville, Winston-Salem, and then here I'm in Durham down the road. And we also actually, our headquarters is in West Virginia. So just in case your businesses extend there in Appalachia, we have flexibility to work across the region as well. And I'll look forward to sharing more later. And Shannon, I know you're focused in North Carolina, right? Mm-hmm. So very good.
Yeah, so Carolina Community Impact is based in Raleigh, but we serve the entire state of North Carolina. And we're a small business lender. So we are SBA microloans and SBA community advantage loans. So that SBA was brought up earlier. We are a participant lender in their programs. So that means that they guarantee our loans if we're doing an SBA loan. I believe PCAP is also an SBA lender. I'm not sure.
We are.
Yeah, okay. So I'm going to kind of give a little background about the industry overall. How many folks in the room before seeing the slide from DEQ have heard of community development financial institutions, CDFIs? A little like tentative hand raises around here. Okay. So there's, yeah, she's going to give the rest. So CDFIs, again, community development financial institution. You can think of us like nonprofit banks. It's a pretty simple way to describe it, but our industry kind of was enabled by legislation, the Community Reinvestment Act legislation of 1977. I had to look that up right before this. But I was going to say 72, and it was 77. So that legislation was developed to combat a history of redlining by traditional financial institutions and discriminatory practices that have been ingrained in banking for centuries. But in 1977, this legislation sort of blossomed the CDFI industry because it empowers banks to invest in community development financial institutions that kind of do the dirty work not the dirty work, probably more so the clean work. That makes sense in this actually, yeah. Or in this crowd, the dirty work. The kind of lending and investment that banks, because they are private institutions with shareholders and such, that they have trouble doing. So loan amounts that are much smaller don't necessarily turn the same profits that a bank needs to turn. or communities that banks don't know how to invest in because they don't understand their cultures or their histories, or locations that banks have a hard time reaching, that, a few years past the 77 legislation, banking has changed quite a bit, and community banks that everyone, anyone here is from a small town. There were community banks everywhere, and now those community banks have really exited, and there's been a lot of consolidation in the banking industry. So CDFIs sort of fill a lot of those gaps, and they lend in everything from small business to consumer loans to mortgages to affordable housing projects. In North Carolina, we have a pretty robust CDFI industry. We have about 30 CDFIs in the state. And again, they do run the gamut from micro lenders like Carolina Community Impact and others that are doing small working capital loans, all the way up to large affordable housing lenders that are doing multi-million-dollar affordable housing projects, all the way up to self-help, which is the largest CDFI credit union in the country, happens to be headquartered here in North Carolina. So we have a really great network here that is a mix of those very, pioneering self-help credit union all the way down to some startup CDFIs that are trying to do new and innovative things. And it's just a really cool industry to be in North Carolina in particular. We also run the gamut from very localized, CDFIs that are focused on a very small geography, all the way up to national reach with folks like Self-Help Credit Union. Institute Capital is regional.
I would call it regional.
Yeah, you're regional. So I just want everyone, if nothing else, I love that little nutshell thing from her presentation. My little nutshell is, we have an emerging coalition. We're not always the best at marketing, I would say, CDFIs in general.
Working on it, yeah.
But we're working on it. But we're very relationship based. So if you reach out to any one of us, we can route you to the right path. I think I feel confident saying that. And if we can't figure it out, we know someone who can, probably. And we do have really strong relationships with banks, and I think you'll talk about that a little bit more. Because we have this symbiotic relationship. Banks fund us in order to get this CRA credit. They fund us, or they often participate in our loans, or they buy our loans, or what have you, different ways that banks can sort of adhere to this CRA legislation. But one of them is investing in CDFIs and partnering with CDFIs. So a lot of times we're known for doing what banks can't do or won't do. So I'll let you, I think you have some slides you wanted to go through, sort of talking about how CDFIs think about who we invest in and how.
Great.
You can just tell me and I will.
Yeah, if you could go to maybe the next slide. So yeah, just kind of already touched upon this, but as Shannon kind of noted, I think the big thing to think about is we're mission driven. So we don't have the same sort of profit requirements that a commercial bank does. And the way that kind of manifests itself is we do tend to be very relationship oriented. We're very customer oriented. And, generally we would tell you if you can get a better pricing, better loan, we would encourage you to do that. So we're very much looking out for the interest of our borrowers. And because we don't have the same sort of profit requirements, we have some flexibility across some of the parameters of how we lend and how we structure loans. Next slide. So you may have heard of the 5 C's of credit. And I thought this is kind of a good just sort of framework to think about whether you're working with someone like us or pretty much any bank. This is kind of how we think about loans and whether or not we're going to make a loan and on what terms. So the 5 C's are character, capacity, capital, collateral, and conditions. And character basically is, you're trying to answer the question, is this person going to pay me back? And kind of a good indicator of that is prior prior behavior. So what does the credit score look like? Have they paid their utility bills? What do the references say about them? Capacity is a very important piece, and I think for us in particular, in particular, what we're looking for here is what is going to be the source of repayment for the loan. So we give you money. What is going to be that source of money, cash flow, month in, month out, year in, year out, over time, over the duration of the loan, that's going to ensure that you can cover the loan. What we typically look at is we look at the net cash flow of the business against the loan payment that you have to make as a ratio. And typically we want to see that you're generating, at least in our case, 1.2 times cash to the amount of principal and interest payment that you need to make, or interest payment that you need to make in certain instances. And so that's a very important kind of component in what we're going to drill in on. And what we also want to see is that source of repayment ideally is diversified. So you're not totally dependent on a single customer or single contract, or ideally you have a couple sources of repayment. Like one of the prior slides, you're getting paid for pickup and product sales. And there are a number of things that give us comfort that if one aspect of the business, something changes, there's another backup source of cash. Capital is basically, we want to see that you've got skin in the game, because it's very difficult to walk away. It's more difficult to walk away from a loan where you stand to lose something. If you're borrowing money and you're borrowing 100% of whatever it is that you need to buy, there's less of an incentive to ensure that loan pays out. So that's kind of your capital contribution to the loan. Collateral, you can kind of think of that as plan B. So if for some reason the cash flow that we thought was going to be there to repay the loan doesn't materialize or changes, or the business, falls on hard times or goes out of business or whatever happens, we'd like to see that there's some other sort of thing of value that we could look to get the balance of our loan repaid. And that's very similar to auto loan or your house loan. You get a mortgage, they're going to put a lien on the house because if for whatever reason you can't repay that, that gives the bank some security that they can liquidate to get repaid. And then finally, conditions is really what's the market environment. And just, I was trying to think of a relevant example. A friend of mine actually was looking to potentially buy a asphalt paving business. And so in this moment where we're at war with Iran and fuel prices and petroleum prices are going through the roof, and we don't know how long they're going to be high, that's a business that's highly dependent on the price of petroleum. In the composting world, there's a component of your expense makeup that's transportation. So those are the sort of things that we're going to look at and try and make an assessment on, if the macro environment changes, how adverse is going to be the consequence on the business. Next slide, please. So this is just for self-help specifically. And again, as I said, self-help, we do small business loans. My particular group, Self-Help Climate Capital, tends to do sort of larger loans. We're out of the venture fund. And we are specifically focused kind of more on clean energy or projects with clean energy characteristics. But just generally speaking, sort of in the venture fund, we're looking at loans in the $1 million to $20 million range, typically within the self-help footprint. So we operate in 10 states, North Carolina, South Carolina, Georgia, Florida, Virginia, Connecticut, Wisconsin, Washington State, California, and Illinois, mainly Chicago. We can lend outside of those states, but that's where we're going to prioritize. And these are just some examples of the type of equipment types of things that we lend against. the sweet spot for us really is, and kind of where our DNA is, we like to do real estate backed loans. So to the extent you, and we also do a lot of project finance. So if you're building a facility on land you own, that would be a project that we could consider quite easily. If you are looking to, buy truck hauling or compost hauling equipment, we may not be the best for equipment finance. That is something that we'll do and look at, but oftentimes there are other lenders, a gentleman here, that are just better suited for that, closer to that market, know it better, can price it more aggressively for you. In my particular world, and particularly if we get access to our NCIF funding again, we and our partners are going to be very interested in electric transportation, energy efficiency, electrification. Let's say you had a facility that was using a lot of power and you wanted to power some of that with solar. That's the type of loan that we could look at and potentially be helpful with. Or if you wanted to electrify a fleet or part of your fleet, again, that's kind of in our specific wheelhouse. Next slide. And then this is kind of small. I won't go through all of this, but these are some of the parameters that you're going to negotiate with your lender when you actually go to do the loan, and some of the things that you're considering. What's the size of the loan? How long is it going to last? So how long do you need it? And the term of the loan, the term and amortization, those are kind of two key concepts. So the term is how long the loan lasts for. The amortization is how quickly you have to pay back principal against the thing that you're investing in. And so an example, we do a lot of solar lending, let's say. The useful life of solar equipment is 25 years plus. So we might do a 5-year term loan, but we would amortize it out over the useful life of the equipment. So it's not that in that 5 years you have to pay back the full price of the equipment. You just have to pay the kind of pro rata amount of what that equipment's worth. And so that's an area where I think CDFIs can be helpful, that we oftentimes can consider longer amortizations, which brings your monthly payment down in a way that sometimes commercial banks can, or differently than commercial banks. So that is a key lever that we have to play with. The fixed rate versus variable rates is very similar to mortgage. It's all about allocation of risk. So a fixed rate loan has more risk for you and for us. Well, it has less risk for the borrower because they know exactly what they're going to have to pay over a period of time. It has more risk for a bank because they've got to borrow the money to lend to you, and that the price of that can change over time. Interest rate is just sort of the pricing, and the way that I think all of us tend to think of that is we have a cost of capital. In our case, most of our capital is coming from depositors. So there's a certain cost to get those deposits in, to maintain them, and then we put a sort of a reasonable spread on top of that because we got to pay for our operation. But again, a big difference, I think, between CDFIs and commercial banks is that spread can be probably doesn't have to be as aggressive because we have kind of more flexibility there. Loan to value is important. Typically you're not going to be able to go get a loan for 100% of the value of the thing that you're trying to get a loan against, in part because that's the lender needs coverage in the event that the loan doesn't work out as everybody hopes that it will. And then fees, just a note on fees. Again, I think CDFIs tend to have very reasonable fees. There is a cost to executing loans. So typically we capture that in something called an origination fee. But again, our objective is not to make money on that aspect. It's to cover our costs. And so you don't typically see as high fees working with nonprofits as you might with for-profit lenders. And then to some degree, prepayments a high-class problem that's good for everybody. But again, from the bank's perspective, sometimes you will encounter something called a prepayment fee, which is just a function of there's a certain cost to us to put money to work and pay for a loan. And so that's kind of factored in over the term of the loan. And if the term is a lot shorter or gets paid back early, then we don't necessarily recoup the full cost to us of what it takes to make the loan to you. Next slide. And again, just the comment here, I think there's a wide range of stuff we look at. Small business loans. In our particular case, we're looking at clean energy loans. One key point, we're not a good fit for early stage companies that are not cash flow positive. Typically, we want to see 2 years of successful operating history and profitability. So if you're pre-revenue or pre-profit, then you probably have to find a different type of lender. We're a good fit, as I think somebody commented, for helping a business to grow and to start to scale. But that is a pretty key requirement that we have. And typically, one other thing, if you have an owner in your company structure that owns a large percentage of the company, we're typically going to require a personal guarantee from them to do loans. And that's kind of a non-negotiable for us. And again, it sort of gets back to the philosophy of we want everybody with skin in the game. We are very much here to help. And if these sort of parameters fit and you're thinking, a loan could make sense, we'd love to talk to you.
My goal is to get CDFIs to work with the composting whole industry.
Yeah.
Hopefully in the future we can see some composting projects there.
Sorry, that went like that.
Well, actually, I just have paper. So
Perfect.
Yeah. Hey, y'all, that was a fantastic overview. A lot of overlaps in what he said with what we do. And actually, I think there's probably more than for anyone. I'll keep one because I'm referencing it as well. But if you want to take one, pass it down, feel free. Again, like I mentioned, Partner Community Capital, we actually previously were a subsidiary of the Conservation Fund. So this kind of triple bottom line mindset has been all about what we're all about for a long time. You'll see that reflected in our target sectors listed here as well. And yeah, if you flip to the other side of this, it's not quite as much detail as Locke provide, but around uses, fees, terms, these kind of broad reference points. I think the one correction from the slide from DEQ is we can go up to 2 million now on our own. It was previously 1.5. That's pretty recent change within the last 6 months. So we can go up to 2 million on. When I say on our own, I mean, as Shannon mentioned earlier, we are a CDFI loan fund. So we, unlike self-help, we don't have like branches, deposits. We don't have that basis, but we are a loan fund. So we do lend money out and we're a nonprofit status. So again, we don't have that same requirements that for-profit lenders do. And our headquarters is actually up in Charlestown, West Virginia. We've got folks all over West Virginia, all over North Carolina. And yeah, have been actually since our 25th year, maybe 26, actually last year. Yeah. 2000. So I don't know, time flies, y'all. But, yeah, by the way, thanks for letting me, I just flew back from Colorado. It was very dry there. So I'm like rehydrating. And I was also thinking about it for your business. I'm sure the general climate conditions also affect how y'all are operating too and everything. So in line with what PCAP, Partner Community Capital, another P word to describe us is patience. You may have heard the term patient capital. That can often refer to the term length, as in we can do sometimes extended terms or more often use that tool that Locke mentioned of extended amortization on projects or equipment that lasts further into time to really make the best case scenario possible. And then also patience in a general sense with the process. We are used to dealing with projects that have a longer timeline where other lenders may be like, oh, this is too complex, like, or I don't understand your business. Again, that's why we're here. We want to learn more from you and about, the information exchange. So hopefully we'll get to do a little more of that in the Q&A after this too. And as an example of that, so in the kind of general waste reuse sphere, one of our most recent projects was up in West Virginia. It's actually a tire recycling facility. So a couple parallels there, working with a key part of that business being able to operate was working with their West Virginia equivalent of DEQ to get the permitting done. Again, there's a lot of rules and regulations around tire recycling, and really it's kind of a public service because tire pollution is a problem. Again, y'all might be very familiar with this given your work, but so yeah, that's a really cool operation. I'm sad I haven't gotten to tour it yet, but really cool operation up there in West Virginia. And so we had the patience to work with them through that process and our connections with state agencies as well. Again, like really all of that interconnected work. And another component of that was also how we used a state program to, and when I say participate, actually we use some of our PCAP, Partner Community Capital to lend to the project, as well as a state program called WVCAP. I don't think something exists here in North Carolina yet. I mean, CDFI Coalition in North Carolina recently created. I want to shout out to Shannon. She's doing a lot of work on that to have more opportunities to kind of, this idea of we're stronger together when more people know about us and can do more things together. But using that to help make it the best price, like make the price of capital lower, since the state is also coming in and being like, hey, we like this project too, and going through their process. So we have the patience to kind of work through when a lot of what you do is like navigating rules and regs and grants and like making the best case scenario possible. So that's what we do. And then on the energy side, so we have similarly experienced and would be maybe,
Right.
and in a few years, we hope to continue to be around and maybe have some more funds to work with. But any project that reduces energy use is more efficient. Again, that just tends to be a smart business decision anyway, to have more efficient equipment. Newer equipment tends to be more efficient. So it tends to be a win-win-win. And sometimes it means that you can be eligible for different incentives. So as an example, y'all listed waste reduction partners on your, has anybody engaged with them, by the way, waste reduction partners in this room? So I'm familiar with some of what they do. It seems like an amazing group. I think they're out of West North Carolina, but one of the things they worked on while it was still rolling was helping folks get rural USDA Rural Energy for America program REAP grants done. That tends to be on like straight up renewable side for solar, as well as energy efficient equipment. Very long story short, I had to learn that program my first 6 months on the job when it was alive, and now it's paused. But hey, again, it might open up again. But if you can get through the paperwork, great partners like Waste Reduction Partners, they've got a group of retired engineers who will run through the numbers, essentially saying, hey, if I get this equipment, my energy bills are going to be lower. I'm going to be using less energy. I'm going to be paying less. And this is a great thing for me as a business and also just for the society. And so USDA Rural Development, it's a program of USDA Rural Development. And if you go through their admittedly lengthy process, again, patience, then it's a reimbursable grant up until the passage of the IRA, the Inflation Reduction Act. It was 25%. The last couple of years, it was at 50%. So again, I joined PCAP in June of 24. And so seeing a few projects benefit from that 50% grant, like one of our solar projects, just again, an example of that 50% reimbursable grant, we're able to plug that into the project timeline and say, hey, once y'all get this 50% money back, you can pay down the principal. We have no prepayment fees. Look, if you can pay it back earlier, we're happy to do it. And if that's set up with a grant, even better. Bring that down, and then your payments are lower from then on out. And so those are the kind of ways we structure deals to make it best case scenario for everyone involved. Let's use the public money available, our money, your money, and make it work the best. I think I'll say one more example. Anybody here from Western North Carolina? Okay, fantastic. So one of our recent clients called Deerwood Reserve, actually Wonderland was on here too. We tend to do a lot of eco-oriented tourism, whether it's, river guides or really cool new lodging facilities. So these guys at Deerwood Reserve, beautiful place, by the way. I went for our West North Carolina business showcase last year. They actually renegotiated a conservation easement. And I think it's actually the first example of that happening in North Carolina. Y'all familiar with easements? So you get the tax benefit from it while also ensuring that some of your land is in conservation in perpetuity. So again, it's like an eco resort. It's beautiful. They just made beautiful wedding venue facilities as well. But the only reason they're able to do that is because they renegotiated actually it ultimately have more riparian buffer benefits with their easement holder to come in and actually do more regular plantings and then actually just better on the conservation side while also giving them a limited number of additional development sites in order to make that wedding venue, those facilities even better. It used to be a summer camp, like back in the 1900s, you go in there, they've got these, pictures of the boys in like 1910, like jumping in the swimming pool. But yeah, so negotiating that, took so many months. It took a really long time. And so at PCAP, we had the patience to be like, okay, like we're here, like, let's see if we can get this done and not just like, oh, this is taking too long, forget it. Like if you have something like that, a really tricky situation, we can see if we can make it happen. Or like we said earlier, if we can't, referring to others in around our networks who may be able to help. And that kind of is I think this is a repeat message, like y'all mentioning with grants too, the earlier you reach out, the better. Mm-hmm. So having that feedback on an application, or if you need to get certain ducks in a row, starting the earlier the better is great, because it's going to take some time no matter what, even if it is a more simple or straightforward situation. So I think that's most of what I wanted to cover. If you do happen to be work in Western North Carolina, we have some philanthropic funding, officially now available to help if that is a factor in your business, to help with rebuilding in the region. And like I said, our CLEM is a great lender out of East North Carolina. We got some folks in the Triangle, so we're all over the state, depending where you are.